When is a positive cash flow property positive cash flow? Well, the answer is that really depends, and it depends on the investor. So what I want to do today is share with you a small piece of software which is very powerful, really great value. I spent about $2,000 on analysis software many years ago when I first started investing because I wasn't aware this was on the market. But this is very easy to use. It provides some outstanding reports which can make it easy if you want to give a report to a lender with a potential purchase that you want to get funding for. It might be a joint venture that you want to convince that this is a really good deal. And it just puts everything into the most professional output so that you can see the assumptions that have gone into creating that cash flow analysis, as well as all of the indicators and guesstimates that you have about the future. So whether you're a buy and hold investor, whether you want to buy, renovate and sell, whether you're looking at a number of different properties and you want to compare them, this would be an awesome tool for you to use. I'm not going to go through all of it in detail. I obviously do resell this software for the Summers family, and that's because I love it, and my clients use it all the time. So on some of my packages I do give it away because it's so awesome. But I'm not going to go through the how-to because that can take a little bit of time, and a lot of it is quite intuitive, so it's going to be fairly straightforward. But I just want to show you what it can do for you and the type of information you can get out, and why it's important to always do your own analysis. So this is a report that I prepared earlier, and I'm using a dual key property because from my perspective, as I mentioned, I'm very full on to positive cash flow. So this is often dual keys are going to give you a better return for your investment, and that's the reason I'm using this one, but that's beside the point. Bottom line is that you get to put in all of the information. You can put in the property value, you can include on there the purchase costs, and you can change all of that, how much you put into the deal. The loan amount gets automatically calculated from the other information that you put in. The growth rate, you can estimate yourself what that's going to be like over a period of time. The inflation rate also, so that you can work out what's going to increase in relation to the income as well as the expenses, what the gross rent is now, and also the cash deductions. So when you go into the cash deductions, you'll find there's a lot more information, especially in the rental expenses, where you can input things like what the management rates will be, what the rates and taxes will be, what the maintenance might cost, whether you're paying water or whether the tenant's paying water, if there's vacancy rate. You can even include in there holiday letting and different percentages for peak and off-peak rates. That's awesome. With the interest rate, you can include more than one loan. So if you're drawing down on one property as a deposit for the loan for the next property, then you can have two loans that go in there. You can go from interest only to principal and interest at a certain period of time and change the interest rate at that point as well. So it actually puts then everything as a general amount in the overall interest costs. It will tell you, it will give you an option rather for the depreciation. It already works out the stamp duty for you, which is awesome as well, depending on which state, and you can choose that and you can change those parameters where necessary if you're going to be doing a house and land package, for example. The depreciation, it will calculate it automatically based on some certain parameters, but you can change those as well. You can play around with the depreciation of fittings and the loan costs also. You put in your own income, and this is where the difference can be between a positive and negative cash flow property. So when you find spruikers telling you that this is positive cash flow, they'll often be assuming that you're perhaps on $180,000 or top tax rate. They'll also be perhaps assuming that you're only going to be borrowing 80% and the other 20 or 25% is coming out of thin air and not costing you anything through another loan. So all of those types of criteria, and that's why it's always important to do your own analysis. The projections will come out with 1 year, 2, 3, 5 and 10 by default, but again you can change those and you can have it coming out to tell you whether it's income or negative. The different parameters can show you there. So this one, for example, is going to show us that after tax, based on this person's criteria, their income, they're going to be coming out with about 117 net cash flow per week on this property, which I think is awesome. Down the bottom, it gives you the options to show you what the gross yield, net yield, all the basics are, and you can also put a picture in, and you can put the full address in as well if you want to. So that's what you get to see. It does take you through a much more easier format to include all of this information before it comes onto a spreadsheet, so you can use it either in a very much user-friendly system or straight through to the spreadsheet. But what I want to show you is the report that you can get from this. So for example, I might go to reports and I might say, well look, I want to have a cash flow analysis on this one, and it will come up with all of the information that I need. I can even be specific about reducing this format so that it's more of a summary. For example, I had one coaching client, we were doing a lot of these reports, so we just wanted a 1 or 2 page summary. But this will show you just about everything. If you wanted to give this to a lender, it's going to show you the loan detail that you've got in mind. If you're going to show it to a joint venture partner, it shows exactly what you've taken into account. You can put disclaimers down here. These are all basically computer generated illustrations, and obviously if you have a client and you want to be using this to help guide them, then you would want to make sure that you buy the professional version, and you can also brand it as well as make sure that the information you put on there covers yourself when it comes to disclaimers about not giving any financial advice. This also goes down and shows you everything that's been put into that spreadsheet, but in a written format, so that you can, as I say, give it to somebody in a PDF format. They don't have to have this software to see all of this. All of the finance, all of the expectations and analysis, every reason why this information has been given the way it has, so that if anybody wants to say, well look, if it were me, I'd change this amount and I'd change that amount, I'd change the interest rate, I'd change the vacancy rate, whatever the case may be, all those things are variable. Same as depreciation of fittings, etc. So if you get a quantity surveyor in, they give you a different type of depreciation schedule, then obviously you can change all that. Cash flow projections are obviously one of the key things, and that's what you're looking to find out, because if a property is going to cost you $120 a week, that's going to limit the amount of properties that you can buy in your portfolio. If it's going to put $100 in your pocket, then obviously that's going to make it a lot easier for a lender, a joint venture partner, anybody who wants to be an equity partner with you, to feel comfortable about the fact that this property is not going to be a burden to you, but an asset. Obviously, capital growth is something we can't guarantee, but that's where you get to put in what you believe the growth rate would be over a period of time. And of course, you can be conservative, or you can be optimistic, or you can do a number of different reports that will give you each option. It also tells you, how the cash flows go over time, and you get an amortization schedule as well. So it's awesome. Who pays it? The tenant's paying most of this, the taxman's paying the rest, and the investor isn't paying anything, which is the way I think it should be. But there you go. So this gives you a huge report. As you can see, we're down to page 7, page 8, with all of the information that you could want. If you were going to be doing some extra renovations to this property, you can add that in as well. If you're going to be paying off a lump sum in a period of time, you can include that also, and it will recalculate everything for you. If you're looking to do 2 or 3 properties, you can do, as I say, a summary report for each one. So absolutely awesome piece of software, I believe. I do resell it, so go along to investorfriendlyagents.com.au and you'll be able to see in the shop there where you can purchase it. There is also an opportunity for land agents, coaches, buyers agents, etc. If you want to buy the professional version, it is a bit dearer, but it really is worth it, because you can have a number of licenses then for your staff to use, and you can put in all of your branding and your own disclaimers. Now, if I haven't convinced you that this is the software that you need, and you have a buy and hold strategy, then I've obviously not done what I should have done, and my communication is really bad. If you need to find out more about the product, I suggest you go to my website, investorfriendlyagents.com.au, and then just click on the shop option, and you'll get to a couple of the products, and the one that you're looking for at this stage is the personal use, PIAFPU, and that will give you a lot more information, so you can read through it and understand a lot more about what this software provides you. As I say, it's an amazing investment. Now, if you are looking to buy property and you're not too sure if you're getting the right one, it's not just about the analysis. That is one of the tools, but the first thing to make sure is that you're buying a property that's going to suit your strategy. So first of all, understand your strategy, then you know what you're looking for, then you can do your analysis, and then you know if you're on the right track. The worst thing that can happen is people buy a property with the wrong strategy, and then they don't enjoy it, doesn't work for them financially, doesn't suit their personality, whatever the case may be, and they end up not investing further. Huge tragedy. So if you need to find out a little bit more, if you want some help, I can provide you a 15 to 20 minute free consultation. Just give me a call on the same website, investorfriendlyagents.com.au. You'll find an option to book a call. Just click on that, it'll show the times that I'm usually available, and then we can have a chat. Obligation free. I just want to make sure that investors don't go down the wrong track. Don't just buy properties because somebody's trying to sell you one. I want you to make sure that you buy a property that suits you. Anyway, have fun. Property investing is all about having fun and enjoying the journey. If you don't do that, then perhaps you should look at another type of investment vehicle. But from my perspective, I have a passion for property. If you do too, I wish you all the best and make sure that it's a very positive experience.